Are tech stocks dead? The technology sector has been down by more than 30% from its high as of early June 2022, and the bears have taken over the Nasdaq, which is mainly concentrated in the IT sector. Things seem to be getting even more discouraging with news of tech companies facing layoffs to cut costs and in anticipation of economic slowdown. So are tech stocks still investable? Should we take this opportunity to buy tech stocks at great prices? Let us learn more in this video. Hi guys, this is Hazel from the Joyful Investors. Before we share with you on whether we think that tech stocks are still investable, let's just take a look at an overall picture of how the various sector ETFs have performed since the start of the year. So year to date, the XLK and XLC ETFs, which have holdings in tech stocks such as Microsoft, Adobe, and Alphabet, have been among one of the worst performers in 2022. You may wonder, why are tech stocks hit particularly the hardest among other sectors or stocks? To understand this, we got to understand the concept of discounted cash flow. During times when we are in a very low interest rate environment, the future earnings of these growth stocks are discounted at a low interest rate, which results in higher valuation. But when interest rates rise, the future earnings are now discounted at a higher rate, which causes the valuation of the tech stocks to fall. That's the conceptual explanation based on discounted cash flow. Now, if that seems a little too technical and you want to understand more on the logic, here it is. When money does not cost you that much, that means to say that the cost to borrow is lower, it is alright for us to receive the profits that growth stocks generate 10 years or 15 years down the road. That is also why many unprofitable tech stocks, which have high revenue growth rates, had very high valuations previously. However, when the cost of money goes up higher, in other words, when interest rates increase, the value of these deferred cash flows will now decline. Growth stocks such as tech stocks in particular, they are hit harder than value stocks by this change in interest rates because the cash flows are further into the future. So with the negative sentiments that we are facing right now, do tech stocks still make a good investment? Here are some reasons why we think that tech stocks may still do well over the long term. A quick disclaimer, this is not a recommendation of any investment. Please exercise your own due diligence. The biggest question to ask ourselves is, would there be growing demand for technology services moving forward? Just take a look at how the world has changed in recent years. In China, almost the entire population in the cities downloaded apps such as WeChat Pay and Alipay to integrate mobile payments into their daily lives. For retail investors looking to invest, various investment brokerage companies facilitate an easy and interactive investing experience where investors can just invest from their smartphone apps and consume content on that same app. Closer to home, we also see that FairPrice embarked on its Scan and Go initiative, where shoppers can now scan the barcodes of their groceries on the go for a more seamless shopping experience. Even museums these days incorporate technology to create more unique experiences for the visitors. At the back end, businesses utilize technology solutions to improve their workflow and processes, incorporating automation and data analysis to increase the productivity, the efficiency, as well as to deliver higher quality services. The pandemic has also accelerated the need for businesses to embark on digitization. Technological innovation these days is no longer an option right now, but an essential to survival for businesses. To add on, the global labor shortage that the world is currently facing may also accelerate the use of automation to offset the impact of labor shortage by cutting down on the mundane, repetitive, and time-consuming tasks that the workforce handles. The secular growth drivers in technology are here to stay, and would be more deeply rooted in the markets going forward. While we are currently experiencing volatile periods, the sustainable growth that is offered by the tech companies will likely return to favor. In terms of valuation, it seems that the current valuation of the Nasdaq is nearing its long-term average after a big rally in the last 2 years. If investors were rushing in to buy during the pandemic rally, why not buy now when prices are cheaper? In fact, the recent news of tech companies freezing hiring or executing layoffs may not necessarily be entirely bad news. In some ways, this might help to loosen the tight labor market that we are facing right now. And that may then bring down the wages and bring about some deflationary impact. Now, I use the word might because in an economy, there are just too many factors that are changing and impacting the overall state of the economy. There are also some who think that the current tech layoff is an indication of an upcoming recession, because during a recession, there are usually more layoffs and higher unemployment. On the bright side of things, many other industries are still lacking workers. So perhaps it is not just all doom and gloom. But before you get overly excited and start your shopping spree in the stock markets, don't forget the fundamentals of the tech companies. Please do not get me wrong and start investing in any tech companies that you know. It doesn't mean that if a stock is a tech stock, it is a good stock. We want to only invest in those businesses which have shown healthy financials and are still poised to grow, especially during this interest rate hike period where valuations of tech stocks are deflated due to the rising interest rates. We want to avoid flashy growth stocks which are still struggling to make profits and do not have a wide moat. Instead, we want to hold on to businesses which have a track record of healthy financials, companies which are profitable and can continue to maintain the strong pricing power despite this inflationary period. Businesses which consumers are still willing to pay for their products and services even if they raise the pricing. Or businesses which have sufficient cash flow to tide through the difficult times. Let's always remember that in investing, fundamentals are our last line of defense. Though the tech sector is being beaten down due to the current economic condition, strong fundamentals are what would bring up the prices of the quality businesses at the end of every bear market. So that's a sharing of our views on the current tech sector, and I hope you guys benefited from this sharing. Do note that this sharing does not mean that the tech stocks will rebound back immediately in the markets. But if you are an investor, then you should always look at the bigger picture. Set longer-term perspectives and consider the long-term outperformance of your investments. In the short term, even the best company in the world or any Warren Buffett endorsed stock can still be beaten down temporarily. Thank you for watching this video, and if you enjoyed the video, do give the video a like and share them out. See you in the next video.